from Camuso CPA. Welcome to the latest episode of the Financial Frontier, where we talk Web3, cryptocurrency, and digital asset, regulatory news, and advice based off of what I'm seeing at my practice at Camuso CPA. I have a lot to get into today. There's been a lot of headlines and news around some of the recent regulatory developments in the space. So I want to get right into these topics today and discuss some of the things that I've seen happen recently. So I think it's going to be pretty interesting. So let's get into it here. I'm going to attempt to share my screen. This is the one. Okay. So first, a few things I just want to bring to your attention is on November 3rd, this is actually the wrong event, but on November 3rd, we will be hosting an event here on LinkedIn, a LinkedIn audio event called the Crypto CPA Q&A. Here you'll see it. So on November 3rd, we have over 483 attendees right now, and I'm really excited for this event. It's formatted differently than these lives. These lives are video based and primarily me delivering information, although you're free to post comments and I'm happy to address them. This crypto CPA Q&A is really going to be focused on answering questions that you have top of mind as an audience member, and you'll be able to post those questions ahead of time or ask them in real time, and I'll be there to address them over this event. Something else I wanted to bring to your attention is later today, in fact, at 2 p.m., me and Steven with GivePact I'm going to be joining their Twitter space, and we're going to discuss the future of crypto tax policy in the US. So this is at 2 to 2:30. You can go over and find the event link here and be sure to sign up for that. Steven has a great perspective on the regulatory environment related to digital assets, and he has a great set of questions and topics that we're going to discuss. So I think we're going to get into a lot of detail on some of the topics that I'm even going to discuss today, but we're going to go into further length on them, and then we're going to discuss some other things that I'm probably not going to discuss today, like the proposed NFT regulations, NFT sales tax regulations, and many other important topics that are going to be out of the scope of this video today. And lastly, as I always do, I want to encourage you guys to go to my website at camusocpa.com, sign up for the Digital Asset Digest. This is delivering weekly updates directly to your inbox every week on everything you need to know from a regulatory, tax, and accounting perspective related to digital assets. So, okay, let's get right into the headlines. First, this was released by the IRS, and they're outlining some priority areas for targeted compliance work for crypto, or for targeted compliance work for the year 2024. And there's many things they're going to be focusing on here. One interesting one is FBAR, but obviously the most interesting is expanded work on digital assets. So this says here the IRS continues to expand efforts involving digital assets, including work through John Doe summons effort in last month's release of the proposed regulations of broker reporting. So everything that the IRS is doing, these John Doe audits, the broker reporting, it's all information collection to start to build a clear picture on a taxpayer's actual activity that they may not be reporting. So the IRS virtual currency compliance campaign will continue in the months ahead after an initial review showed the potential for a 75% non-compliance rate among taxpayers identified through record production from digital currency exchanges. So what the IRS is saying is that based off of the records that they've collected from various exchanges over the years, mainly due to John Doe audits, they're seeing that with the data that they have, that there's 75 non-compliance rate. So there's 75% of people that they've collected records on, they don't believe are filing these transactions. And of course, that's going to lead to them pursuing those taxpayers eventually. So that is a huge number on the non-compliance. Now, obviously, we've seen other studies that say that there's a large degree of non-compliance, but this is coming directly from the IRS, and it's based off of actual data that they have. So this was a pretty shocking statistic, and it strengthens the IRS's case to have an increased level of scrutiny and information sharing within this industry. So, sort of on that topic, we recently saw Kraken announce to its users that it's going to, as a part of a John Doe audit, have to hand over its information to the IRS. So basically, they're going to be giving the IRS all the information that you gave them related to your name, date of birth, tax ID, address, and then Kraken's also going to be giving the transactions all the way going back from 2016. So this is another example of, taxpayers may have thought years ago Kraken wasn't KYC, and maybe they chose to not include trades from Kraken or not include trades from anywhere and only trade on exchanges that they thought were not KYC. Well, now the IRS is going to have that information. And, this is happening not just on Kraken, this is happening across many centralized exchanges. So, what do you as a taxpayer do in this scenario? Well, if you have transactions on Kraken or any other exchange for that matter that you haven't claimed, you need to obtain those records. You need to do your cryptocurrency accounting accurately. And then you need to go ahead and you need to file and amend your tax returns to accurately reflect that. It's much better to be proactive in these scenarios than sit back and wait till you get a tax notice from the IRS. The tax notice is probably not going to give you as good as an outcome related to your cost basis as if you would have done the calculation with all of the information available to you from the outset. So if you want to get the best possible tax picture for yourself and you want to avoid compliance headaches, it's better to be proactive in your tax reporting. So now they're going to get all this information, and when they're getting this exchange information, that's going to include withdrawals and deposits, which is going to include non-custodial wallet addresses. So these John Doe summons are one of the biggest tools the IRS has right now, because that's how they're collecting the majority of the data. And then that data is what is used to start to build an actual transaction history on a taxpayer. So this doesn't come as a surprise. Kraken was fighting this for a while, but they lost. So they're going to be giving all the transactions from 2016 to 2020. So that is something to keep in mind if you've traded on Kraken, or even if you haven't traded on Kraken. Just the fact that these John Doe audits are not stopping anytime soon. So somewhat switching gears here, IRS crypto tax reporting rules threat to industry, says Coinbase legal chief. So what he's talking about here is the new proposed crypto tax reporting rules, which are basically attempting to turn both centralized and decentralized exchanges into a tax reporting regime that's similar to securities brokers, where eventually taxpayers would really just get to receive a 1099 that has all of their transaction history already reconciled and presented to them so they can claim it on their taxes. So there's a lot of criticism around this, and personally I probably have some criticism around it too, because I think that the proposed regs are overarching. So you'll see here, Coinbase crypto exchange chief legal officer Paul Grewal called upon the crypto community to join a movement against the United States Treasury's proposed reporting regulations. So he's arguing, as many others are, that this sets a dangerous precedent for surveillance, and I would not totally disagree here in this regard. And he goes on to say this would put digital assets at a disadvantage and threaten to harm a nascent industry when it's just getting started. So I think that's most of his quotes in here. He goes on to say, sets a dangerous precedent for surveillance of the everyday financial activities of consumers, requiring nearly every digital asset transaction, even a purchase of a cup of coffee, to be reported. And this is accurate. These proposed regs are saying that every single transaction needs to be reported and monitored by anyone that's acting as a centralized intermediary that can obtain information on a taxpayer. So that means that even if a decentralized exchange has a front end website that they control, they're going to fall under these broker requirements and would have to report your activity to the IRS. And that would put you as the taxpayer in a position of providing a lot of your sensitive personal details to these companies or these startups in order for them to have the tax reporting be accurate. So you'd be doxing all of your wallets, you'd be providing information to all of these decentralized exchanges, and then they would be reporting every one of your transactions to the IRS. So that's why, many people are seeing these broker regs as a huge threat, just because of the level of tax reporting that it's requiring, and the fact that due to how it's written, it's going to extend to most decentralized applications, because currently right now most decentralized applications have is still centralized in some regard at some point in their design, whether that's in their front end website or at other points. There's going to be some centralization that's going to have them fall under these broker requirements. So what the crypto community is trying to do is basically two things. They're trying to push back the implementation of these broker regs. Right now, it's going to be partially implemented in 2025, and then in 2026, we'll have cost basis reporting information. So right now, these are just proposed regs, and there are efforts in giving comments to the IRS to try to push back the effective date of the proposed regs. And then on the developer side, what needs to be worked on there is achieving true decentralization, because to the degree that that is achieved, there may be an exclusion from these broker reporting requirements. But just keep in mind, right now as it stands, most DEXs that you're going to think of or use are going to fall under these reporting requirements. Now, similarly, the EU, in other news, formally agrees on new crypto tax data sharing rules. Now, this is basically going to be the EU's version of these proposed broker regs. The rules set to be published in the EU's official journal force crypto firms to report on customers' holdings to be shared between tax authorities. So this is going to be a similar reporting regime that we see over in the EU. So you can see that this is something that is, going to be extending across tax regimes across the world. So the European Union rules that let tax authorities share data on individuals' crypto holdings were formally adopted on Tuesday. The rules were proposed last year in a bid to block assets from being stashed overseas using crypto. So this is the same thing. Right now, this is going to be the next tool that's used by regulators. They have the John Doe audits on many of these exchanges, and now moving forward, they're trying to implement a system to where that information is automatically shared with them up front. So this law is known as the 8th Directive on Administrative Cooperation, DACA 8, and it forces crypto companies to report information on customers' holdings that will automatically be shared between tax authorities. So they say that this complements MICA and other AML rules. So this is very similar to what we're seeing here in the States. This is sort of where the tax regulators are at, is trying to get some regulation in place where transaction information and tax information is shared with them up front, Now, the real controversy and issue around all this starts to become with the fact that there is the decentralization in this space, and taxpayers are not going to be inclined to share this information, particularly, when they're interacting with decentralized exchanges. Now, why we see that, the Coinbase compliance officer saying this is going to stifle innovation in the US is that once these regulations are implemented, these DEXs are either going to have to comply with these rules, or they're going to have to basically geogate out US users in order to avoid the necessity for them to comply with the rule. So that sort of is the risk associated with these aggressive proposed regulations, both in the United States, in the EU, and in other places that we're seeing it. So like I said, there's been a lot of pushback on this, and I made a post about this yesterday. It's actually really interesting. There is a crypto lawyer. I should know their name. It's escaping me right now, but they basically created an application that was powered by artificial intelligence that allows taxpayers to seamlessly, with just a couple clicks of a button, draft a comment on the digital asset reporting regulations and send it out to the IRS. So, in this scenario where there maybe only would have been a handful or a couple hundred of these, due to AI and due to the ease that people were able to send these in, there's now has been thousands of them. It went from a few hundred to a few thousand just over the course of a couple of days or weeks, due to the fact that there's been this way to do it very easily with AI. There's been a big push online within the crypto community, and what the goal is that they're trying to basically flood them with comments, and the IRS has to go through all these comments. They have to categorize them appropriately, and they have to respond to them appropriately as well. So, it's just a way where basically it's going to take more time in this regard for the IRS to reply to all these and to categorize them. And what we just saw, that I also just posted about a day ago, was that the IRS has decided, as a result of a lot of this, to lengthen the period for public comments on its crypto tax rules. The decision was made in acknowledgement of the considerable attention that this has garnered since August, largely thanks to AI. Although the attention is true attention, it's not just people using AI, but AI has helped them express that to the IRS. And consequently, the Treasury and the IRS have postponed the deadline for submitting comments on their suggested regulations by an additional 2 weeks. So, this is something we're going to continue to watch closely, and we're going to see what the end result of this is. We're going to see if there's going to be additional postponements, or maybe the proposed regs could possibly be revised to focus. What I would have liked to see more is these initial proposed regs to focus on centralized exchanges. I think the pushback that they're getting, and where the overarching aspect of it is going after the DEXs, but that's where they see the issue in information sharing as well. So that's where the battle is right now on that regulatory front. And then I thought this article was interesting from JD Supra, which is on this same topic. Dueling crypto banjos, two very different reactions to Treasury's proposed crypto reporting scheme. So, there's people on one side of things that dislike the reporting scheme. Those people are usually going to be, more in our industry. And then there's people on the other side of things that absolutely love it. They push for this, and they want to see it get implemented as quickly as possible. So, as you can see here, this outlines some of the dates. January 1st, 2025, gross proceeds will get reported. January 1st, 2026, that's when, basis and character of the digital assets will get reported. But we're seeing, and what's getting reported here is Senator Warren and others are cheering loudly for this and urging an even faster timeline for implementing the crypto tax reporting. Now, it should be acknowledged here that this is something that can only be implemented so quickly. This is going to require a lot of back office administration by the exchanges that are going to have this tax compliance burden fall on them. So right now, with reporting of gross proceeds being implemented January 2025, that already doesn't give a very long time period for them to properly implement this. And then we see people like Senator Warren actually pushing for this even to be implemented even quicker. So this paragraph goes on to say that there's a lot of pushback that we see from our Community to Blockchain Association, Crypto Council for Innovation, the Coinbase Compliance Officer. So that's the pushback coming from our side. But we're seeing people like Senator Elizabeth Ward, Agnes King, Richard Blumenthal, Bernie Sanders, Garen Peters, Sheldon Whitehouse, Brian Schatz, all reaching out to Secretary Janet Yellen and Danny Werfel, the IRS commissioner, urging for them to take more swift action. So on our side of things, while we're pushing to delay this and to possibly revise it, we're getting pushed on the other end as well. So as this paragraph goes on to say it, in the end here, the crypto industry largely disagrees with the criticisms addressed by the letters from Senator Warren and others, which is teeing up a potential standoff between Congress and the crypto industry. So the realities of this actual implementation may over time reveal who has the edge in this duel. Are we going to see these proposed broker regs get implemented fully and in a timeline that people like Senator Warren want, or are we going to see some postponement in how that's implemented and possibly some revisement around the proposed regs, so maybe only portions of it get implemented to a lesser degree, and maybe we see them exclude DEXs? So time will only tell with this. This is something that I'm watching very closely. One thing to be sure is that over the next 2 to 4 years, we are going to see very large changes in the tax reporting requirements related to digital assets. And we're already seeing that now, but this is only going to continue to increase. Many taxpayers may think once we see these broker regs come out, that's it. Your tax reporting for crypto is automated. Maybe one day it'll get like that, but what I'm anticipating, especially in some of these early years, is there's going to be a lot of discrepancies, particularly with cost basis information related to what actually took place with the taxpayer and what is going to get reported on these 1099s from the exchanges and DEXs. So it's going to be very important, just like when we're getting 1099s now, it's going to be very important to scrutinize those, make sure they're accurate, and make any appropriate adjustments as necessary. So crypto tax and the regulations around it is becoming one of the big topics here going into 2024. So knowing that if you're in with that 75% group of people that the IRS has said is non-compliant based off of the information that they had, it's not 2016 anymore. It's time to get into compliance. After this much time has passed, I understand many people may be hesitant to, but it's better to be proactive with this and get into compliance up front before you have tax notices. It is extremely common at Camuso CPA that we are still having people come to us, and we're going all the way back and doing their accounting from 2016 through the current period, getting them into tax compliance after completing the accounting. So if you're in this position, you're not alone, but you want to take the corrective steps, the appropriate steps, and get into compliance as soon as possible. That's what's going to, in the long run, protect your bottom line. So, a lot of movement in the regulatory space. That's really what I wanted to focus on today, because I think this is going to impact the industry as a whole in extremely significant ways when it comes to these broker regs. So we'll be keeping an eye on this and seeing how this develops and see what actually gets implemented. So those were most of the topics that I wanted to hit on today. I know we focused a lot on some of these regulatory points. I think that they're very important. I also think it's very interesting watching this battle between the crypto community and Congress sort of ensue in real time here. So that's really what I wanted to focus on today. There's going to be a lot of topics that I want to discuss next week, and some topics that I didn't discuss today coming out during the week in our newsletter called the Digital Asset Digest. So stay tuned until next week. And in the meantime, be sure to visit my website and check out our newsletter, the Digital Asset Digest if you're looking for more information in the meantime. I appreciate each one of you watching this today. Thank you very much. Until next time, I'm Patrick Camuso.